We're the last session here before breakthrough and then your concert. I'm Alex Ortolani. I'm senior reporter with wealthmanagement.com, and very happy to be here with Paul Saganey of Integrated Partners from Waltham, Massachusetts. So Paul's just come in. It's been a good conference, Paul. I'd say it's the only conference I've been to where the tanner I get, the harder I've worked. I've been out there in the sun. And I also saw today someone in a hoodie blazer. And I thought that might be a Boston thing. I could see someone in a Red Sox hoodie blazer.
Too many Yankee hats around here, by the way, so gotta get rid of those.
It's trouble. Well, look, everyone, we're going to talk about growth through strategic partnerships, and Paul is a perfect person to talk about this. Paul, my first question is going to be a bit of a chance for you to intro as well. Right? You started your firm in '96. You were an advisor. You are an advisor still today. Maybe talk about that a little bit. But you've built it up to over 20 billion, more than 200 advisors, I believe over 70 offices, no PE money. So first question is, how did strategic partnerships in particular lead to that growth, and especially in the early days?
Yeah, so first, good to see everybody, by the way. Thank you so much for being here. For us, strategic partnerships with CPAs was why we put the firm together back in 1996. Actually, 1996 was the first year in Massachusetts that accountants could actually share revenue with financial advisors. And so prior to 1996, I was leading a group of about 27 advisors in New England for a company called Cigna Financial Advisors, which doesn't exist anymore. But our business model back then, through the early 90s to 1996, was we were doing the high net worth activities, the high net worth financial planning for the wealthiest clients at Morgan Stanley, Smith Barney, and Dean Witter. So we would go in, an FA would introduce us, and we would meet their wealthiest clients, which I think is always a plug for when you work with wealthier clients. It's financial planning first, wealth management second. But these FAs would recognize that if we could get in there, do a financial plan, win over the client's confidence, that coming in later and doing the wealth management was far easier. So for 6 years, this was a phenomenal model. We would earn our revenue from charging fees for the planning work that we were doing, and then placing any insurance products for liquidity. So we did a lot of life insurance for estate tax purposes and whatnot. However, though, we would get to know these clients, we'd do a lot of work with them, but we would then give the assets back to the wirehouse environment. And so 96 was a key year because not only was it the first year that accountants could share in revenue, but for those that have been around here for a while, that was also one of the first years with a whole model of charging 1% to manage wealth. That kind of kicked off there in the 1990s. And so I trace my roots back to getting an 8% load on a mutual fund back in the mid-'80s, and another one right here. So the idea of charging 1% was brand new. So imagine us. We're out there meeting super wealthy clients. We're really perfecting our craft. I always tell people this is also the time and era when we were building family office models. So we all know what a family office is today, but that was the beginning of taking families, looking at them holistically, kind of, as I like to say, build a corporation around the family model. So we're at the cutting edge of family office planning as well. So when 96 came around, we saw the opportunity. A very good friend of mine said, who had a very large accounting firm in Boston, why don't you come do for us what you were doing for the Morgan Stanley FAs? And so we got together, myself and one other advisor, working out of 2 cubes in Waltham, Mass, and put the company together. But the nice part of the story was, in the first year and a half, we had basically brought in about $140 million of assets. And so we knew at that point that we really had a model that if we just stuck with it, we weren't looking to be as big as we are today. This will come up later on here. We weren't ever imagining being as large as we are. But certainly back then, we knew we had a model that we could grow, leverage, and really bring in a ton of assets at that 1% number at the time.
Well, maybe it'd be good now, Paul, to ask you about the CPA Alliance you created. I think you have over 200 CPA partners. But how is this different, or how did you build it differently from your traditional kind of COI setup? And how did those client relationships work? Because I do imagine issues must come up with kind of who owns the client when you're starting to really make this more than a referral process. So yeah. curious.
Yeah, a couple. So our model, by the way, is we bring in other RIAs or independent contractor advisors, and so we don't own our advisors' practices. We don't have any W-2 models. So we truly just welcome advisors who get the way that we're trying to grow the firm and invite them in to work with us. So it's their firm. They own their own clients. The typical advisor that joins us, they're already a couple of $100 million or larger. But they want to double, they want to triple the size of their practice, but they don't want to do it with the same clients that they originally built it with. And so why accountants are so important is because, think of my background, when we're going into an accounting firm, and for those of you that are in accounting firms, we're trying to work with the top 10 or 20% of their either income earners or net worth clients. We're not in there trying to work with every single client that they have. And so I think the first most important thing, Alex, is that when you look at the success that we have, we're not in there looking to do every client that the accounting firm has. We're really focused on who we want to work with, but over time, that model has basically morphed to whatever our advisors want to work with. So if our advisors want to work with retirees, every accounting firm has hundreds of retirees. If they want to work with mass affluence, there's hundreds of those. But the real key to the program is getting up to that top 10 or 20% of the net worth client that the CPA has, and that's where you generate by far the most activity and the most assets.
And you, I think, explained it to me a little bit, or tried to say you actually have to actively aim for that, because it must be tempting to drop down. It must be tempting to expand the client base. And why not do that? At some point, didn't you see growth maybe in expanding? Why do you hew to that top tier?
Yeah, I think by far the advisors who are in our world who are getting the largest organic growth numbers are focused on the wealthiest clients. There's no doubt about that. But I think, I always tell advisors, people always ask us, like, what are you doing that works so well, and what can I bring into my practice? The first thing is the accountant, when you start working with a new CPA, they're going to give you the kind of leads that they feel comfortable and they feel they can trust you to work with. So what we always teach our advisors is only focus on that top, once again, 10 or 20%. If they want to, can you open up a $100,000 401k, or can you do a 529 for one of our clients? Have someone else do that, okay? So I use the doctor analogy. If you're going to go to a brain surgeon, you don't want them saying on weekends, I'm also doing some podiatry work. And so if the accountant, doesn't get that you're the expert, you're the best at what you do, if I dip down to a 401k or other types of clients, then before you know it, that's what they'll start to give you, because they're just easy introductions for you. So by staying focused on the wealthiest of their clients, always increasing their confidence, that's step number one, is don't ever let them see you do anything but the ideal client that you want to work with.
Okay. Paul, let's move forward a little bit. Your firm is growing. Money starts to come into the space. Maybe we're talking a little bit early days of aggregation and deals happening. Are you interested in that as you're growing, or are you finding enough organic growth? And I think I've heard a lot, we talked a lot about organic versus inorganic here, and when organic growth is real, when it's sustainable. And again, in terms of partnerships in particular, obviously, as you said, you didn't go the PE route, but in those early days, what were your thoughts, and how are you thinking, we are going to continue to grow in our way, and it's going to be successful?
Yeah, we'll continue to use the accounting practice or the Accounting Alliance program as our primary driver of success for our advisors. By far, our highest organic growth advisors are in the accounting firm program. But we do have it, it's been 27, 28 years now for our firm, so advisors who have been with us the longest are now looking for some kind of an exit. And so once again, we want to make sure that we're the ones that can handle that exit. Although we have no PE money up till now, we're just self-funding our internal transactions. That's important to us because you all know we're all being approached by everybody. Our advisors are being approached. And we want to be that, end of life, if you will, for the practice, organization, because we help them build the practice to where they are today. So we are now, in the last couple of years, now doing internal transactions where our advisors that we have helped to grow, some of these practices are over $1 billion, we're now doing the transaction for their practice. These are typically longer term, 5 or 10 year transactions versus all done at one point. But we're paying attention to the industry. We see what's going on. We know what is being offered out there, and we want to make sure that we are very fair to our advisors. But we don't want to help advisors build their practice and then have them have to go out somewhere else to get their payday, if you will.
Have you faced that, people looking to go elsewhere? That it's made you maybe restructure or figure this out?
It's only happened once. They didn't want to go, but they said, hey, we were offered this. What do you think? And so then our acquisition team got involved and started talking with them. So that will be an internal transaction for us. But as I sit here in front of you, we have actually never lost an advisor. So we're pretty proud of that. And we would hate to lose advisors who are going to be bought out by somebody else. So we will be acquiring our internal practices as time goes on.
Okay, very good. I actually want to stay on strategic partners a little bit in terms of how the industry's also evolved toward, holistic services, right? You talked about some of the other areas of, are we doing insurance, trust and estates, thinking about different retirement areas coming up. It feels fuzzy though, and sometimes you feel like people are saying it because they have to say it, but is the practice, truly have the partnerships that work? What are the partnerships you have in those other areas? What do you think is realistic? And of course, it's going to depend on size, but let's say maybe even a little bit further down the chain, smaller advisor. What's realistic to offer more in financial planning, but in a way that's real and works for the client and the advisor?
For the advisor? Well, I think every advisor has to decide to what level of complexity do you feel comfortable. And so, now the accounting firms we're bringing in have clients that are worth $1 billion or more. And so we as a firm have had to adapt, we've had to improve our capabilities to make sure that we can keep pace with these opportunities coming our way. But I think, if I answer the question, Alex, I think every advisor, even myself as an advisor, to what level am I comfortable before I have to bring in other experts? We use 3 words. We call it the vision, the capabilities, and then the reach. And so those 3 words have defined our growth for the last 27 years. Very clear in our vision. But the word capabilities, once again, is as we get to know the advisor and get to know what he or she is comfortable in terms of the complexity of a case, we'll then bring in our teams or external teams to help make sure that we can bring what's needed for that client. At the end of the day, we owe it to that CPA to make sure that we do the absolute best. We call it our hero program. We want to help that CPA look like a hero to their clients. If you don't know this, the CPA community is also changing, and CPAs are trying to grab for their piece of the pie as well. But going in with the idea, how can we help them be a hero to their clients versus how can we just make some revenue on this? If you have that mental mindset, then certainly you can get far better results.
Got it. Yeah, that's a real partnership right at work. But you did mention the changing CPA environment. I heard it come up on another panel, and it's amazing to think there's another industry out there. It's got aging population, succession issues, consolidation happening. What are the challenges there in terms of the setup that you've worked out? And then are there even any opportunities?
Probably more now than before. So there's 3 things to be aware of. I think number 1 is, like our industry, there are buyers and sellers in the accounting industry as well. So and you want to be careful of that, because if you make a relationship with a smaller, say, local CPA firm, you want to know what their plans are, because these are being acquired by mid-sized firms almost on a daily basis. So first and foremost, you want to know that it's a same as our industry, a buyer and seller market in the CPA community. We as a firm have decided to go up market. So now, really 80% of the accounting firms that we're bringing in the door now are acquirers of smaller firms. We kind of learned our lesson by having some smaller firms that were being acquired and had to leave our program. So now we're at that mid-size level, which is about 25 to say 50 partner type accounting firms that are buying up everybody else. So first and foremost, know that it's a buyer and seller market for the CPA. Number 2, and this is an important one, these trillion-dollar numbers are thrown all the time. $100 trillion will change hands from parents to their kids and whatnot. An important number for a CPA is 11 trillion. What that represents in the next 10 to 15 years, $11 trillion of small business wealth will be sold to somebody else. Okay? Why that's so important is these are the clients that are the highest revenue generating clients for a CPA. that are about to sell their businesses in the next 10, 15 years. So it's, say myself or you, it would be like me losing half of my highest AUM generating clients because they pass away and the money goes elsewhere. So that $11 trillion number is important. Number one, because it's changed the dynamic of a CPA firm. They recognize that they're about to lose substantial revenue, which allows us to come in and replace that revenue. We're a revenue sharing model, by the way, so we do share revenue with our CPAs. And we also provide equity to the CPA firms as well. So we can replace the lost revenue from these business owner clients that are selling with some kind of equity or revenue sharing that we're doing here. And then the last big thing is it goes back to that hero model. CPAs want to do more than just be tax return preparers. They truly want to get involved. They want to make a difference with their clients. They want to, I don't want to say validate their existence, but they want to be part of a team where the client looks back and says, wow, thank you for what you're doing here. Certainly, we'll talk about AI in a little while here, but they see AI, they wonder what that's going to do to the tax preparing world, and so therefore they want to morph out and do more to once again capture the attention of their best clients and be seen as a solution going forward, just someone who kind of prepares their taxes.
Got it. Interesting. It sounds like that revenue and equity sharing, that your revenue sharing and the equity you've done with CPAs may start paying off as they're evolving.
Absolutely, yes.
Yeah.
I would say there's a large percent of our accounting firms on the smaller size where what we have helped them build for a wealth management division of their CPA firm is actually worth more than the accounting practice when they sell that.
Got it. To the audience, I want to remind you, you can send questions through. They'll pop up. If you have questions for Paul, there's a QR code. So please bring them in. So we talked a little bit about the consolidation of our space as well. I want to turn to that. So your firm, you were not you were not acquiring or bringing people into the network for quite a while, and then you decided to. And I want to say, maybe 6 years ago or so, where you brought it in, and we just announced a deal at Wealth Management that you did this week, bringing a firm onto your network. I actually took a quick look at the deals since Monday. What are we at, Tuesday? So I think there's probably 7 deals announced between our outlet and a few other trade outlets. So it's just constant right now. What made you decide you wanted to get into this space? I mean, you can call it in a way strategic partnerships, bringing more people in. What made you decide to get in, and how has that journey kind of been going for you to expand in organically?
With the advisor practices?
Yeah.
There is no doubt that independent advisors, what we all are here, are the best advisors in the industry. That's not to knock advisors who say work for, W-2 companies or maybe employee type models, but we've found that $100, $200, $300 million firm that was built through hard work and really bringing client value to the table, that's our best firm to work with, because when we can introduce that kind of a firm to an accounting practice, get them access to clients that are 10, 20, 30 times larger than their average client, that we can really make a difference. So we've always brought in independent contractors from day one. That's all I knew was independent contractor advisors. And so when we put the firm together, we would find a great advisor and then find a CPA firm, would find a good CPA firm, find a good advisor. We really built it that way until about 2018, 2019. That was our growth model. We were never looking to be a national company. As Alex mentioned, I have my own practice even today, which is it's a large practice. And so therefore that does take up some of my attention. But it was really bringing in advisors that think like entrepreneurs. For us, that's always been the best advisor to plug into an accounting firm.
So thinking like entrepreneurs, take advantage of your CPA alliance, the setup. Okay. Do you think you would have been able to sustain this if we weren't in essentially a relative bull run for the past, through this 5-year period? I think there is a sense that there's been some coasting, and we had COVID, but even that, kind of the dip wasn't that bad. What do you think if we were in a more down environment or a more difficult environment? Would this still have worked? Would you have been looking for capital? How would that have gone?
Yeah, good question. Here's how it works. For us, the best market for client acquisition with an accounting firm is a down market. So the tech bubble, the 08-09 banking crisis, when markets are in turmoil, when clients are nervous, they'll tend to say to their CPA, What do I do? So actually for us, we pick up more assets when there are difficult times going on. I would say right now I would consider this a difficult time. And so we've got an internal marketing company where we're just continually marketing to these clients of CPAs to let them know that if they are nervous, have questions, we're here, we've got answers, and we'll kind of walk them through what's going on. But I would say for us, it's these down periods in the market that we can track our new assets coming in the door from our CPA program. It goes up exponentially during difficult times. Because think about it, if I may say, wealthier clients that are making money, and let's say they're with some wirehouse advisor and they're doing well, and every year they see their statements, they look okay. It's when they see a 20, 30, 40% drop in their money when they start to question, am I with the right team? You know, many times that CPA for a wealthy client is the most trusted advisor, so therefore, when they say to the CPA, what do you think, what's going on, it's an instant introduction to our organization. So we thrive on the down markets, actually.
I got to ask you, because you brought it up, right now you feel that there's enough volatility that you're seeing an uptick, or what are you hearing out there?
Uncertainty. I don't know if there's volatility, but there's uncertainty. And when, as I say, the market loves uncertainty, well, people love certainty with their money as well. Yeah, I would say people right now are talking to their CPA. Maybe you've got friends that talk to you about what's going on. So we want to be in a position to capitalize when those clients talk to their CPA, ask them thought-provoking questions, and then we do work with our CPAs to kind of teach them how then to introduce our advisors. And so it's the marketing with training and just doing it over and over again. We want to make sure we don't miss any opportunities there.
All right, very good. So you've talked a little bit about now the bringing other firms on. How do you feel about bringing in more capital? Do you see the need for more capital to keep your growth going? Maybe your team members now, some of them who are engaged in the M&A side, are saying, Paul, we need more. What is that looking like on the ground for you, and how do you think about it? The other thing I would assume is you get calls. There's a lot of money out there looking for shops, like everything you're saying up here, so you've had growth. So what's that like for you right now? How are you thinking about it?
Yeah, certainly the CPA program attracts capital providers. I won't knock any capital providers, but right now we don't need capital. Any Dan Sullivan people in the audience? Any strategic coach people? So Dan Sullivan, who I've worked with since I've been 27 years old, we work on a series of 25-year plans, and I have 19 more years to go on my 25-year plan currently. And nowhere on that plan is to sell the firm or parts of the firm, and so therefore, I've got the luxury of deciding the direction of the firm, and so right now, we want to take it from our current 220 accounting firms to 500. This transition of wealth, by the way, this $11 trillion number, which we want to get in front of. So we're adding capabilities around M&A. We're now able to take a business through a consulting process of 1 or 2 years. So we're getting the business ready to be sold. We can then take it and actually get it sold and pay fees to our advisors and our CPAs, and then manage the wealth thereafter. And so as I look forward here, we don't need the capital. I'm not knocking capital if people have it. We just don't need it. We're able to self-fund what we're doing here. And I'd expect we're going to do it for a long time. I don't see on the horizon doing anything with any private equity capital.
Well, let me ask you to put on maybe just an expert hat, or as you look at the industry, what firms do you think should be, might benefit from it, particularly maybe if they're looking to build out programs, or they have ideas that, because it's about the technology, or about, they have an idea for some CPA alliance that they think is going to revolutionize and they need capital. How should they be looking and thinking about this?
I think it goes back to those 3 words. So what's your vision for your firm? I'll be honest with you, when we started at zero in 1996, we got to about $3.5 billion by the end of 2018. So the growth from 3.5 to now 23 billion has really been in the last 5 or 6 years. It was hard to go from that $2 or $3 billion shop to get past $5, $6, or $7 billion. So depending on where your firm is, we just gutted it out, and I'll be honest with you, because I've got a practice and I could make a living on my practice, I could reinvest every dollar back into building integrated partners. So paying myself or keeping myself and the family going was not an issue. So it was really self-investing back into the firm. But there is that 2-ish to 5 to maybe 6 billion, depending on where you are, that it's hard to get through that number because expectations are higher, especially if you have other advisors on your team. You have to add more capabilities, which costs more money. So that was a hard period for us to get through that. But then we got past like 10 or $12 billion. Wow, then things really started to really go for us. And so I think if I were you sitting in your shoes, go back to that vision. What's your vision for where you want to take the firm? And then what capabilities do you need to make that vision a reality? And if those capabilities require you to spend money you don't have, then I would certainly go and look at a capital provider. But everything we do, that's what we do. It's what our vision is, where we see the business going the next 5, 10, 15 years, adding the capabilities around that. And then as you know, that last word, reach, that's our accounting practices. Because although we talk about 200 accounting firms, there's 180,000 clients that we have access to their tax returns. So by contract, we can walk in and look at 180,000 tax returns. Something like 37,000 of them are small businesses. And as we just talked about a second ago, $11 trillion of that 30,000 marketplace for us will be changing hands. And so, we made it through the difficult parts where capital would have been nice, but I could live on my practice. And now we're at that hyper-growth mode right now. And I think the business owner community, the accounting community, the changes going on are certainly, which I think for you, as I share this with you and you think about your practice, you should be doing the same thing. So who are the accountants in your community? Who are the people you can partner with to get you in front of those business owners? That is a very satisfying engagement to help a business owner get ready to sell their business, actually get it sold, and then when everybody shows up to manage the money that came into existence, like Bank of America and people like that see the money in the bank, you know the money's coming your way. And so I know that we talk a lot, I heard a speaker earlier talk about the fact that as our clients pass away, are we working with the next generation? For business owners, we can get ahead of that curve. We can certainly get the families involved, but that'll be wealth that will stay with our firm for many, many, many years.
Very good. That gutting it out period sounds very interesting. And maybe, where a lot of people teeter, it's like, what am I going to do in this period? This is a shameless plug for you, but do you write about this? You said you do have a book about the evolution of the firm. Do you talk through some of that gutting out period and how you got through that?
Yeah, we've done 3 books. So I did one book is a book that goes out to our accountants to talk about our practice and how it is different and what the owner of an accounting firm should be considering. It's called Optimizing the Financial Life of Clients. It's a great book. We hand it out, but it really does kind of give the playbook for working with a CPA firm. The second book is called Making Smart Decisions, and that's a book we put together, which we hand to business owners, high net worth individuals, and it kind of tells them the questions they should be asking us. And so what I've learned through my experience, if I can hand a wealthy client or business owner kind of the playbook to follow, and then I can then answer the questions from the playbook, it just kind of moves the relationship forward. And the last book actually is called Center Stage. So my practice is over 400 clients, but I only work with 5 or 6 of them. So that's all I work with in my practice. So it's a series of what are called second chairs. We've got different planning teams around my practice. And so this book called Center Stage was basically a story of how I built my practice. And the reason why that was important for our organization was, as we bring in successful advisors, the number one challenge to an advisor when they join our firm is creating the time to let those advisors go and work inside the accounting firm, because they're already very busy running 300 clients and $200 million of assets. And so therefore, what we learned is that if we didn't help the advisor reimagine their practice, reimagine how they could build it, very much along the model that I use for myself personally, then we could never free up their time. And by time, to really make a good accounting firm work, you need about 2 days per week, like of dedicated time in the firm, looking at the schedule that the CPAs are doing, talking to them, increasing their confidence. And so if you want to step down this road, it's about 2 days that you would need. So think of your practice. Could you, starting next week, just start to take 2 full days and focus on these much larger clients? That's what the book was put together to do, is help advisors reimagine the model of their practice based on how I put mine together.
Got it. Okay. It's a good segue, because you're talking about that, that time management and asking them to take that time. It's going to pay off. I want to talk, we've been talking human partnerships. I want to talk about AI partnership. I know you said you spent a week deep diving into AI. A lot of the conversations I've had here with advisors is, yes, we're now using it for notes. And one advisor I thought said it pretty well. He's like, I can focus on my client, have the conversation. Sometimes it's emotional, and I'm just talking to them because it's being recorded, and then a summary is going to spit out, and I can look back at it. So that's basic level. There's some sort of more advanced administrative things, conversations around mining the history of client conversations and pulling up at different moments what's needed. Can you talk a little bit about that week AI deep dive, what you found, what the possibilities you see, and I guess book 4 is going to be the AI book?
Yeah, I am all over AI, by the way, so this is my big passion. I'm involved in 2 study groups around AI. One study group is about looking at the future of AI. We spent about 30 hours last week. His name is Peter Diamandis, called Abundance 360. So for those who know Peter, so we spent 30 hours last week hearing from the creators of the future of AI. And so in other words, we as entrepreneurs could hear what they're building and then try to get ahead of that curve. My other study group is about just the blocking and tackling of how to use AI to make our lives easier. For years, Alex, I was taught a line about 10 years ago. I love this one. What's the business that will put you out of business, and how do you build it first? So a good friend of mine told me that 10, 12 years ago. And every single day as I look at integrated partners and our model and where we're going, and certainly I pay attention to the industry, but that phrase, what's the business that could put us out of business, how do we build it first, has been really at the forefront of our organization. We changed that though with AI. Now our phrase is, what's the business or the technology that could change our business, and how do we get ahead of that change? And so I don't think that AI is going to get rid of what I do, I'll say, or get rid of what you're all doing. But certainly as I pay attention to what's coming down here in our industry, what I can use now to make my life easier. Personally, I'm now using AI in client meetings. So my clients tend to be wealthier, multi-family challenges and different dynamics are going on. So for me, in our firm, we're using AI now in client meetings where we can, here's a good analogy, by the way. So every year I get a medical done. So it's this medical process I go through. It takes about 4 hours. They check everything. Ready for this one? This is the first year that half of my physical was done by AI and half was done by a doctor. Okay. Now, the reason for this is because what this doctor program had learned is that one doctor was missing all these different medical records. They were missing certain challenges or certain medical problems that the patient had. When they added AI could diagnose the blood work and everything else that's going on there, and they were able to find health issues far, far quicker. So think about that for a minute. So my physical this year was half done with AI, assisting the doctor along the entire process. And I like that because I think that information is now democratized. It's out everywhere thanks to AI. And so I want my clients to know that when I'm looking at their situation, not only do we have internal teams and experts to kind of help guide the planning process, but now we've got 1 million of the smartest minds in the world that are helping to put the plan together. And so for me, and for our firm as we're kind of going through this process here, for wealthier, more complex clients, we're really finding that AI can assist us along the process. It's been really very helpful.
And so, right, that true kind of co-pilot method.
If I could add, so this one family had a tremendous net worth, and they wanted to talk about estate freeze techniques. And so they wanted to make sure, did we look at everything? Isn't that a great question? They've been a client for many, many years. But they were like, have you checked everything? Have we looked at every possible outcome? And so we used Perplexity for that particular fact pattern. And then we just basically had a meeting where we asked Perplexity questions, and we talked about what are the options for estate freeze techniques. And so for those that know how to use AI, if you put the phraseology the right way, you can then at the end say, ask us 5 or 10 questions. Wow, it really just took our meeting to a different level. And kind of like me with my health, I now know that 1 million of the best, doctors in the world looked at my medical results. I think that client now knows that 1 million of the best minds in financial services were looking at what they're doing. And so we want to keep pushing that narrative that we've got great talent here, but we're looking at what's out there to make sure that, you're getting millions of eyeballs on your plan, not just 1 or 2 of us.
Well, I'm interested. You mentioned, I think, one of the services you use or vendors. How are you approaching it and saying, okay, this is worth the cost? Are you looking at vendors out there to bring in the AI that can then mine your own data? And where the question's going is I do feel like there's maybe a little, it can be used as a little bit of a threat, especially if you're a smaller advisory where it's like, oh, you don't have this, it's going to be trouble for you. And you're sitting there going, well, I don't really know how to get it, or I'm not sure exactly who to trust in the space. But maybe you talk a little bit about how you're doing it and then what you would say to those people who are like, yeah, it sounds great, but who's the vendor? How much does it cost? Will it really save time and money?
I think personal opinion, I think I'm always careful with technology because, go back to the words, my vision for the future, the capabilities and the reach. I don't want to put the capabilities before my vision. In other words, I do find some advisors see a new technology and they kind of change their path as to where they want to go. And so we're very careful with technology and what it can do for us. We're at a point now where we're now building our own technology, our own software systems, our own back office systems for advisors. The beautiful part about getting to the size that we're at now is we can reinvest our own capital back into trying to build more AI-based solutions for our particular business model. There's some amazing platforms out here, by the way, in what they're doing. But I think for us, we're taking what's out here, we're adapting it to our vision for the future. But we're in a great spot where now we've got the capital to build our own. So we're now investing in our own solutions for both the back office of a practice, but also what our advisors are doing in front of their clients. And
are you finding that you'll be talking about that with, maybe potential advisories joining you? Is this, does it become a selling point as would other, sort of unique aspects
Certainly,
of the business, that are proprietary?
I think anything that makes an advisor's life easier and frees up the time. The big word for us is time. So if it's going to free up the time, that we'll love it. And then for me, once again, being an advisor and bringing AI into my client meetings and seeing how I can use it, especially with wealthier business owner clients. If you're an advisor by yourself or in a small group and can't afford maybe a large, legal staff for estate planning, wow, you've got AI sitting right in front of you. You've got 1 million of the best estate planning minds sitting right in front of you. It's how do you bring that into a client meeting and how do you get the client engaged with that service? So I would think that, going back to how we did this in the past, we have a large estate planning team, a large business team that works with our business owner clients. We're finding that much more of that work is now done behind the scenes, but also in front of the client using AI.
All right, very good. You mentioned the wealth transfer, and it was another area. Because I think it's not just the advisor space that's changing, right? But it's the clients that are going to start to come in. How do you see trying to adapt for the younger generation as this $11 trillion wealth transfer happens? We just talked AI. Is there other partnerships or things that maybe firms need to be thinking about in terms of tracking that transfer, engaging the next generation, making sure they stay with you, because they're different breed in a sense. Grew up on tech, grew up on maybe more wealth savviness as we always read about.
Right. So if I heard correctly, so in my practice, some of my second chair advisors work with the children of the clients that I work with. So that's kind of our way of capturing multi-generations, if you will. My focus, though, is on business owners, on high net worth clients. We have something we call the complexity curve. Actually, you'll like this. For those of you working with an accounting firm, not only do you want to work with the top 10 or 20% of their clients, but we use something called the complexity curve. And what that means is you want to catch a client where their wealth is becoming more complex. Business gets larger, assets are larger, so their financial life gets more complex. But probably more important is their personal life getting more complex. So if you really want to get the best, so if you're in a new accounting firm, you want to find the best opportunities. We call it practice profiling. It's like doing a fact finder on an accounting firm. But you want to look for those dual complexity curves, not just the wealthiest or the highest income clients, but you want to get the client to talk to you about their family situation, the marriages, the grandkids, the client's marriage. So imagine for just a minute, if I can combine those two complexity curves and meet in the middle with a very high net worth client that's going through a lot of life's challenges with their family, like that's huge. And we use a formula, by the way. So when we put a new advisor into an accounting firm, we use something called 6 times 10 plus 1. This works over and over and over again for us. And what that means is that when you go into an accounting firm, your goal is to find 6 clients that are 10 times larger than the average client you work with today. So if you look at your entire book and it's $1 million, let's say on average for all your clients, when we go into a new accounting firm, going back to the beginning of the talk here, setting the expectation with the CPA, it's about looking at those clients that have $10 million or more of net worth, okay? And you want to get 6 of those. Like if you get 6 of those in a year, that's a great year. The plus 1 part, by the way, is think to yourself, what is the single largest revenue generating client you've ever brought into your practice? A lottery winner, an advisor the other day works with widows and widowers, the sale of a business. So what's that single largest client you've ever had in your practice? That becomes your plus 1. Because the theory being is that you can do that plus 1 over and over and over again because you've already done it before. And so maybe that 6 times 10 will bring you up to that client level where maybe you're not as comfortable and you've got to lean on either other experts or AI or people to help you through the process. But the plus 1s you can do over and over and over again. So if you can imagine, just go home with a little piece of paper, but if you're looking for those kinds of clients in the accounting firm, what will that do to your assets? So if you're getting 6 that are 10 times or more larger, plus 2 or 3 of the largest client you've ever worked with before, and do it over and over and over again, that's the basic foundation of how we set the expectation for our advisor inside of a CPA firm.
Very good. I might not have the assets. I've got more than 2 complexities, though, Paul. I can promise that. So this is a good segue, though, on CPAs. We have a question from the audience. So what's the best way to approach CPAs to discuss strategic partnerships?
I think don't talk about money, for what it's worth. For them, it's about, go back to the word hero, as I said earlier. How can you help them be a hero to their clients? The second part is you want to do like you do a fact finder to your clients. You want to do a fact finder to the accountant. You want to ask them the 80-20 question. You know, what is the 20% that brings in 80% of your revenue? So as I said earlier, if you can attach their 80-20 and show to them the fact that these are business owner clients that the next 10 years will most likely sell their business, you start to get them thinking, wow, how do I maybe, monetize my status as the client's most trusted advisor? And so for us, it's about this fact-finding process called the practice profile, getting to know their 80-20, and then trying to find how stable is that 20, okay? So if it is small business owners that the CPA tells you their average age is 58 to 60, the next 10 or 15 years, they'll be losing those clients as revenue-generating clients. And so I think similar to what you would do with a client, follow the same process. Ask questions, get to know what they're doing, dig as deep as you can, and then start to give them a view of what the next 5, 10, or 15 years will look like for their accounting practice. But then, more importantly, what you could make it look like with them. And so when we go into accounting firms, our whole model is about helping that ABC accounting firm build ABC wealth management. And so therefore, you're helping them to build a larger franchise or franchise that they can monetize at some point for far more money than they could before. But just do like your clients. Just do a fact finder, get to know what the future looks like for them, educate them about the next 5 or 10 years, and then start to introduce what you can do.
Very good, thank you. So we have a minute left, Paul. You mentioned the plan that you've laid out for yourself. I'm not going to ask you to get too deep in it, but what's the future looking like for you and integrated partners?
Yeah, so as I said earlier, so we want to get to 500 accounting firms, and so we will continue to add talent to handle the capabilities around that transitioning of the small business owner market, so that $10 trillion, $11 trillion of small business wealth that will be sold to somebody else. We're getting ahead of that in a big, big way. And then also using, our internal systems to make, the advisors' lives far easier working with their everyday kind of clients. And so once again, freeing up the time for an advisor is the most important thing we're trying to do here as well. But for those of you in the audience here, we've been doing this for 28 years, never been a better time to talk to accountants about partnering with you. Literally never been a better time. You just have to take your time, educate them, get them to see where they have some, parts of their practice that maybe won't make it for 5 or 10 more years. Bring in what you can do to help them kind of build a better future for their practice. But once again, we see the future being better than the past.
Very good. Thanks so much, Paul. Appreciate it. Great conversation.
Thanks so much. Appreciate you being here. Enjoy it tonight.